In a major policy shift, the Central Bank of Nigeria on the 27th of July 2021 halted the sale of foreign exchange to Bureau de change operators. The governor of the Apex Bank at the 4th MPC meeting for this year announced the ban of Forex to BDC operators in the country. Well, according to him, this is in a bid to curb the dubious and unwholesome practice by the BDCs. The ban, according to him, will ensure that the Apex Bank discharges its statutory function efficiently and sanitize the Forex market, thereby directing commercial banks to set up teller points in designated branches for the sale of Forex to customers. Since the new foreign exchange policy took effect, the Naira has had an eventful run, with the rates reaching as high as 525 Naira to a dollar at the parallel market, before appreciating back to 510 Naira to the dollar on Monday, 9th August 2021. However, economic experts have the view that the implication and effect on economy and Nigerians will be adverse, as the country remains a largely import-dependent economy, which will affect the cost of production. Well, he's live via Skype is the Chief Executive Officer of Cowrie Assets Management Limited, Mr. Johnson Chukwu. Good afternoon, Mr. Chukwu.
Good afternoon to you.
Yes, we've been talking about this so very well, even before now. But first, I know it might be a little bit early for us to judge, but in your assessment, let me just go straight. Do you think the commercial banks will be overwhelmed with this? Can they handle this situation?
Yes, they can. Commercial banks can handle it, but the problem is not the commercial banks. The problem, they are twofold. One is that the commercial bank getting as much supply of foreign exchange from the central bank as to meet the demands of the economy. That's the core of the problem. No matter the channel of distribution you adopt, if you don't have enough supply as to meet the demand, you're still going to have that pressure on the exchange rate. Of course, you did mention the pressure on the exchange rate. I understand at the last count, Naira was trading about 521 Naira, meaning when I asked somebody to check what the rate was yesterday, he said 521 Naira to a dollar, the cash exchange rate. And if you recall, by the time the central bank intervened in that market by removing the BDCs, the exchange rate was about 504 Naira. So we've seen a depreciation of about 19 Naira within that period. And the core of the second part of the problem is that you have to look at the distribution channels. The BDCs seem to have more pervasive distribution channels. Beyond that, under the central bank regulation, there are certain legitimate transactions that need quick access to foreign exchange that will not easily get it from the banks. They were getting it from the CBN. I mentioned a few of them. Those who want to travel, you are entitled to a business travel allowance or personal travel allowance 4 times in a year. And if they can't get it from the banks, they have to get it from any source. There are people who are into cabotage business that need to pay their shipping company charges with dollar. If you apply to get your shipping company charges from the banks and submit your Form A, you are going to take donkey weeks or months to get that. So if you're under pressure and your goods are with a shipping company, you have no choice than to go and source for Forex from any source. There are people who are trying to get school fees for their children. It's expected that you get that from the banks. But if it's dragging too long beyond the time limit you have to make those payments, you may have to get from any other source. So these are some of the demands that the current structure seem not to be responding to or responsive to. And unless the central bank has to develop a fast-track mechanism or system that will accommodate those that need Forex quickly, and as well as increase supply to the bank so that they can meet the demands of the economy.
Some say, if properly implemented, that this pain might just be for some time. Yes, it might be high since we're import dependent, and in a matter of time or in the short term, the positives of this policy might begin to surface. Do you agree to that sentiment, Mr. Chukwu? Hello, Mr. Chukwu.
Yes, Tolu.
Okay, can you hear me now?
Yeah, I can hear you now.
All right, thank you. I was saying that some have argued that if this policy is properly implemented, this maybe this bashing of the naira, if you allow me to use that word, might just be for a medium time or short term. That in the long run, we might just get the positives of this policy. Do you think along that line?
So the core of the problem, like I said earlier, is supply. There is, unless we see an expansion in this inflow of foreign exchange into the economy, and that expansion can only come from three major sources. One, are we seeing an increase in our export earnings? If you look at the GDP figure that was published, we realized it was stated that crude oil production in the second quarter of this year was only 1.61 million barrels, compared to 1.81 million barrels per day that it was in the second quarter of last year, which will indicate that 200,000 barrels per day shortfall when you compare that to the figure of last year. That implies that our foreign exchange earnings coming from crude oil sales is declining. Second source of foreign exchange earning will come from capital importation. Of course, under the current macroeconomic environment, foreign portfolio investors are finally going to come to the economy. Similarly, foreign direct investors are not likely going to come in the immediate future. So that source of capital importation is not likely going to materialize in the immediate. The tail leg of it is diaspora remittances. And as you know, the central bank had actually come up with some policies to incentivize diaspora remittances. But unfortunately, I don't think they've achieved any traction from that, because you have to consider the current global economic environment. Several countries have not achieved the same level of employment they had prior to the COVID-19. And a lot of Nigerians who live in diaspora are not earning as much as they used to earn prior to COVID-19. And therefore, no matter the incentive you create for them, like what the central bank called naira for dollar, they are not going to remit to their dependent monies they don't have. So you see, those three elements that will support an increase in foreign exchange earnings are challenged. So it is not what policy the central bank adopts that will drive naira exchange rate or lead to an improvement in the exchange rate. It is when we have improved demand, improved supply of foreign exchange, or in the alternative, if you can suppress demand, which we know is an impossibility. You really can't suppress demand by whatever method you want to adopt. As long as those demand are genuine, people, a population of 200 million people will have certain level of demand for imported items, unless you can produce those locally, which could be import substitution. But for you to achieve that, you need to improve your productive capacity. You need to improve the infrastructure supply that make it possible for us to produce goods efficiently and cost effectively.
Before I ask you, definitely I'm going to talk about the GDP figures, because to me, anyway, we're going to talk about that. I want to also ask, staying with the Forex issue, another argument is the fact that we should allow the forces of demand and supply to run this market for us, just like they say in the petroleum market that we should allow for deregulation and allow the market forces determine the price of PMS. If we do that to our FX space, in our FX space, what do you think might happen? I just like your views on that.
What will happen is that we're going to see a further depreciation on the naira. Probably we could get to a point where the exchange rate will stifle demand or lead to a reduction in demand. But for you to do that, you have to also address the second aspect which you mentioned, the issue of petroleum subsidy. So let me mention this at this point. The demand for petroleum products in the country, which is financed from our foreign exchange reserve, seem to be overly bloated. We have moved from an era where about 20 million, 25 million, 30 million liters daily consumption was considered as outrageous. And now we're talking about 100 million liters consumption. And that is being financed from our foreign exchange reserve. So if you adjust the price of petroleum products to be market reflective, to be cost reflective, what will happen that whatever is smuggled out of the country, whatever is not recorded as imported that is not actually imported, whatever that is a wasteful consumption will be eliminated. And you drag down the demand to something maybe between 5-30 million liters per day. which will help us conserve a lot of amount we are spending on foreign production of petroleum products. So both of them must go hand in hand, which will cut down on imports that is either financing demand in other countries or are actually not goods imported into the country. So you need to address that before you talk of allowing market to determine the exchange rate. But even if you do the market determination of exchange rates and you do not address demand and supply equilibrium, what you will see is an adjustment in price. But that adjustment in price would ordinarily lead to a reduction in demand.
Now, the GDP figures trickled in today, and of course, 5.01%. Mr. Chukwu, to me, this is unprecedented against all odds. How does it come to you?
Well, it did come to me as a lot of surprise, or a major surprise, because I recognize the fact that the economy went to a deep trough in the second quarter of last year. If you recall, in the second quarter of 2020, the economy contracted by 6.1%. So, and when you measure the GDP figure for the second quarter of this year, you're measuring what was the aggregate value of goods and services produced in the country in second quarter of last year compared to what it was in the second quarter of this year. And because there was little production last year, and the economy contracted, so any uplift will lead to a material increase. And I want to emphasize, with looking at those figures, look at transport and storage. That sector grew by 76% in the second quarter of this year in real time. Transport and storage was completely locked down in second quarter of last year because there were no flights, vehicles were not moving, rails were not moving. So you almost had a zero economic activity in transport and storage. But by the time you restored flights, transportation, and all those things, you saw an increase of 76% in the quarter. Year on year, with sector GDP growth in the second quarter of this year. Another classical example is trade sector. Trade sector has been in recession for years, but because trading activities were almost shut down in the second quarter of last year, if you look at the trade sector for the second quarter of this year, you saw a growth of about 22% in trade sector. So does that mean we're seeing a lot of commercial activities, or what we did was we saw a recovery from what a complete shutdown in the second quarter of last year to some level of economic activities? What I'm trying to emphasize is that the growth of 5.01% was largely assisted by what we call base effect, because the base had actually declined drastically in the second quarter of last year, and any recovery could lead to a steep performance when you measure it in percentage terms.
Let me follow up. Services sector also recorded a strong performance of 9.27%, according to them, the fastest growth since 2010. What do you make of this, and also non-oil sector's performance?
Yeah, the key things are the basic facts applies to many of those sectors. Apart from a sector like oil and gas, the crude oil sector, where production was going on last year, irrespective of the lockdown. And as you know, all the oil majors continued the crude oil production throughout the period of the lockdown. Unlike other sectors, services sector, that virtually people, almost all of us stayed at home, and there were minimal economic activities, non-critical sectors of the economy. So that's what influenced a lot of those sectors. But before we leave, I think I need to mention some areas that should be of concern to the government. And one of which is agricultural sector. If you look at agricultural sector performance, we've seen a 3-quarter decline in agricultural sector, despite the incentive that the government has been trying to create in that sector. In the fourth quarter of 2020, the agricultural sector grew by 3.41%. First quarter of 2021, the growth rate declined to 2.28%. And the second quarter of 2021, we're dealing with an agricultural growth rate of only 1.3%. The simple reason is that the heightened level of insecurity is driving away farmers from their zones, from their residences, and many of them are living in IDP. And that situation is still not improving. We need to address that. The other area I think should be a clearing cut to the government when they do a proper analysis of the GDP is the information and telecommunication sector, where growth is slowing down and slowing at a fast rate. That sector accounts for 17.92% of the GDP, but its growth rate has slowed down to just 5.5%. And these are sectors that should actually propel further economic growth rate. So if we just look at the non-oil sector growth rate of about 6.74%, we need to disaggregate to what sectors are driving that. I had mentioned transportation and storage, which grew by 76%. I had mentioned trade, which grew by about 22%. These are the major propellers of the growth. And you remember that trade accounts for about 16.6% of the GDP. That led to that 6.7% growth in non-oil sector. But we must also be conscious of the fact that some sectors are slowing down. We must not lose sight of the need to stimulate them. Agriculture accounts for about 22% of the GDP. So it's slowing down, and you can't afford to allow that to continue. We must address the issue of insecurity, and we must address the issue of policy environment that is impacting negatively on the telecommunication sector. As you know, only yesterday there was multi-choice had been imposed a tax of 900 billion naira to pay to the federal government. And when I saw it, I screamed, because I said, look, federal government total revenue last year was just about 3.5 trillion naira. And you want one foreign direct investor to pay you 900 billion naira as tax. And they are saying the tax liability is 1.8 trillion naira. What message are we sending to foreign investors? I think we must harmonize the message we want to send if we want to attract investment into the economy.
Before I let you go, would you also say that this figure shows that commercial activities are fully returned to pre-pandemic levels, if you are to assess this? Don't forget, the third wave is still around the corner. Delta variant.
Well, there's been material recovery in several sectors of the economy. Trade sector, I mean, shops have been reopened, supermarkets have reopened. Whether demand have gone back to pre-COVID-19 era, I'm not sure. And then the transportation sector, the airlines, the haulage companies are also going back to business. But whether we've gone back fully, I doubt if we have gone back fully. Of course, if you compare the GDP contraction in the second quarter of last year of 6.1% to the growth of 5.01%, it indicates that we may not have gone back fully to where we were prior to COVID-19.
All right, so let's look ahead. What are your projections moving forward? It's almost end of the year. We're getting to September very shortly. We have 3-4 months to the end of the September, October, November, December. What do you think? What are your projections for the next quarter?
I think we may still see a positive GDP growth rate, but it will not be as steep as what we saw, because the base effect, if you remember, the GDP contracted by about 3.9% in the third quarter of last year. So the steepness will not be as it was in the second quarter of this year. So, but we are likely going to see further growth in the GDP. The key thing is for the government to sustain the GDP at those areas where we are slowing down, so as to ensure that all the key sectors of the economy are growing. That's when Nigeria will begin to feel the impact of the GDP recovery.
And is that synergy that we also need from the fiscal and the monetary side? Because many talk more about the monetary side too much, and we can't keep throwing money at everything.
Yeah, most of the things I referred to here are the rims of the fiscal authority
side.
If issue of addressing insecurity in the country can only be addressed by the fiscal authorities or the executive arm of the government, it's not a monetary issue. So issues of the tax policies, regulations are at the hem of affairs, at the purview of the fiscal authorities.
It's always a pleasure talking to you. Thank you very much, Chief Executive Officer, Cowrie Assets Management Limited, Mr. Johnson Chukwu. Enjoy the rest of your day.
My pleasure.